Inflation is a financial phenomenon that affects virtually everyone. It's the invisible force that slowly erodes the value of your money over time. While it might not be immediately apparent, its long-term effects can be significant. In this video, we will explore the key impacts of inflation on your finances. By the end, you will have a deep understanding of how inflation can shape your financial well-being and strategies to navigate its challenges. Let's get started the video. Impacts of inflation on your finances. Purchasing power erosion. One of the most direct impacts of inflation is the erosion of your purchasing power. Put simply, as prices rise over time, the same amount of money can buy fewer goods and services. This means that the purchasing power of your salary, savings, and investments diminishes. Imagine you have $1,000 in a savings account earning 2% interest, and the annual inflation rate is 3%. While your savings might grow by $20 due to interest, the cost of living increases, and your $1,020 will buy you less than it did a year ago. Uncertainty in financial planning. Inflation introduces an element of uncertainty into your financial planning. When inflation rates are moderate or low, it's easier to make long-term financial projections and set realistic goals. However, when inflation rates are high or unpredictable, it becomes challenging to estimate future expenses accurately. For example, if you're planning for retirement, you need to account for the fact that the cost of living will likely be higher in the future due to inflation. Failing to do so could lead to financial shortfalls in your retirement years. Impact on fixed income investments. Fixed income investments, such as bonds and certificates of deposit, CDs, can be particularly vulnerable to inflation. These investments provide a set interest rate or yield, which means that as inflation rises, the real, inflation-adjusted, return on these investments can diminish. Suppose you invest in a 10-year bond with a 3% annual yield, and inflation averages 2% per year over that period. While your bond may provide a 3% nominal return, the real return after adjusting for inflation is only 1%. Inflation can eat away at the purchasing power of the interest income generated by your fixed income investments. Impact on cash savings. Savings accounts and other cash-based instruments often offer interest rates that struggle to keep up with inflation. When the interest you earn on your savings is lower than the inflation rate, the real value of your savings decreases over time. For instance, if your savings account earns 1% interest and inflation is running at 3%, your savings are effectively losing value at a rate of 2% annually. This means that your money isn't working for you, and you're losing purchasing power by keeping it in low-yield savings accounts. Higher borrowing costs. Inflation doesn't only impact your savings, it can also affect the cost of borrowing money. Lenders often adjust interest rates to compensate for the erosion of purchasing power caused by inflation. This means that when inflation is high, interest rates on loans, including mortgages and credit cards, tend to rise. Higher borrowing costs can strain your finances, making it more expensive to finance major purchases or carry credit card debt. This can have a cascading effect on your overall financial health, potentially leading to increased debt burdens. Impact on retirement income. Inflation poses a significant challenge to retirees, as it can erode the real value of their retirement income over time. Many retirees rely on fixed pensions, annuities, or withdrawals from retirement accounts to cover their living expenses. Suppose a retiree's annual expenses amount to $50,000, and they have a fixed income stream. However, if inflation averages 3% per year, their expenses will increase to $51,500 in the second year, while their fixed income remains at $40,000. This creates a $11,500 shortfall, which must be covered by drawing down on savings or investments. Impact on investment returns. Inflation also affects investment returns. When inflation is low, it's easier for investments to outpace the erosion of purchasing power. However, during periods of high inflation, it can be challenging for investments to generate real returns adjusted for inflation. Consider a stock portfolio that yields an average annual return of 7%. If inflation is 2%, the real return on the portfolio is 5%. But if inflation rises to 5%, the real return drops to just 2%. Investors may need to take on more risk or seek out alternative investments to maintain their purchasing power in a high inflation environment. Asset price appreciation. Inflation can impact the value of tangible assets, such as real estate and commodities. In some cases, inflation can lead to rising asset prices. For example, during periods of high inflation, real estate values may increase as people seek to hedge against the declining value of currency by investing in physical assets. However, this appreciation isn't uniform across all asset classes or regions. Additionally, it can lead to housing bubbles and speculative behavior, which can have negative consequences. If asset prices become disconnected from their intrinsic value. Impact on economic growth. High and unpredictable inflation rates can have adverse effects on overall economic growth. When prices rise rapidly, consumers and businesses may delay spending decisions or hoard assets to protect their purchasing power. This can lead to decreased economic activity, which can, in turn, impact job growth and income levels. Central banks often take measures to control inflation by adjusting interest rates and implementing monetary policies. While these actions are intended to stabilize the economy, they can also have repercussions, such as increased borrowing costs and changes in investment behavior. Diversification as a hedge. Given the many ways inflation can impact your finances, diversification becomes a crucial strategy to mitigate its effects. Diversification involves spreading your investments across different asset classes, such as stocks, bonds, real estate, and commodities. By holding a diversified portfolio, you can potentially benefit from the appreciation of assets that tend to perform well in inflationary environments. For example, stocks of companies with pricing power, the ability to raise prices in line with inflation, and investments in real assets like real estate and commodities can act as hedges against inflation. Inflation is a pervasive force that can significantly impact your finances in numerous ways. It erodes your purchasing power, introduces uncertainty into your financial planning, affects the returns on your investments, and can even influence your borrowing costs. For retirees, inflation can be especially challenging, as it erodes the real value of fixed retirement income. To navigate the impact of inflation on your finances, it's crucial to adopt strategies like diversification, investing in assets that can outpace inflation, and staying informed about economic conditions and central bank policies. By taking a proactive approach, you can better preserve your financial well-being in an inflationary world and secure your financial future. For more videos, like and subscribe to our channel. Thanks for watching the video.